So you've thought about building a crypto trading bot. And if you have, you've probably seen all the hype, right? Well, this explainer is going to be different. We're going to cut right through all that noise with a research-first approach. This is your clear, evidence-based roadmap. Okay, let's get into it.
This is the big question, isn't it? It's the one everyone wants to know. On one side, you see these promises of passive income, just letting a bot do all the work. And on the other, there's that voice of skepticism, the honest answer. Well, it's complicated, but it all starts by asking the right questions, and more importantly, looking at the right data. In this slide, this just gets right to the heart of the problem. You've got the hype screaming, "My AI just prints money," but then you look at the actual academic evidence, like this paper from 2022, and the story is completely different. It shows that many of these profitable bots are just statistical illusions. They're over-optimized on old data, which basically means they're built to fail in a live market.
So, that is our mission here. We're just going to ignore the gurus, we're going to tune out the crazy YouTube videos, and instead, we're going to follow the trail of peer-reviewed evidence to find out what actually has a chance of working.
First things first, we have to navigate the minefield. We're going to start by looking at all the common traps and the flawed strategies that cause most people to fail, often before they've even written a single real line of code.
Let's kick things off with one of the flashiest strategies out there, deep reinforcement learning, or DRL. Now, this quote from the research is an absolute bombshell. It's saying that most of the incredible results you see published are probably false positives. The AI didn't actually learn a real strategy, it just memorized the past. And that makes it incredibly fragile and dangerous when you let it run live.
And trust me, DRL isn't the only trap. The research is pretty clear on a few others. High-frequency trading? Forget it. As a solo builder, you just can't compete with the big firms on speed and fees. Sentiment analysis? The data's super expensive and gets outdated almost instantly. And pure price prediction, well, that leads to a really interesting and kind of sneaky problem.
Okay, now this is fascinating because it's so counterintuitive. Recent research highlights something called the prediction profitability gap. You could literally have a model that correctly predicts which way the price will go 60% of the time and still lose money. How is that possible? Well, things like transaction fees, slippage, and especially poor risk management can completely wipe out your wins and make your losses even bigger.
And if you think these are just theoretical problems, think again. Knight Capital, a huge Wall Street firm, lost $440 million, not in a year, not in a month, in 45 minutes. Why? A single bug in their trading code, and, crucially, no kill switch to stop the disaster. It's a brutal reminder that without safety nets, even the smartest strategy can lead to total ruin.
All right, enough about what doesn't work. Let's totally flip the script and talk about what the evidence actually points to. It's time to separate that hype from reality and focus on the three families of strategies that have real, solid, peer-reviewed support.
So when you boil it all down, these are the top 3 contenders. And it's not because they have cool names, it's because they have the strongest foundation of evidence. We're talking about trend following, statistical arbitrage, and simple rule-based systems that blend a clear signal with really robust risk management.
And look, this isn't just an opinion. We've got the receipts right here. You've got research from 2023 confirming that momentum is a real thing in crypto. Another study showed that even simple tools like the MACD indicator can beat just buying and holding, even after you account for fees. This is the solid ground we want to build our bot on.
Okay, so we've got all this great research. How do we turn that into an actual plan? Well, that's exactly what this next section is about. A practical, actionable blueprint for your very first bot, grounded in everything we've just talked about.
So here it is, a recommended minimum viable product, or MVP. We're going with a trend-following bot on the Bitcoin 1-hour chart. But here's the key. It has a regime filter. All that means is the bot has a rule to only trade when the market is clearly trending. If the market is choppy and going sideways, it just sits on its hands and waits. And the logic is super clear and simple. The signal to trade is a classic MACD crossover, but only if the ADX indicator is above 20, which confirms we're in a strong trend. Every single trade risks exactly 1% of our total equity. And our stop losses? They're based on the average true range, which is great because it means they automatically adjust to how volatile the market is.
Now, building the bot's logic is only half the job. This part, the validation protocol, is completely non-negotiable. You have to backtest with realistic fees, you have to do walk-forward testing to make sure it's not overfit, and you absolutely must paper trade for at least a month. Seriously, skipping these steps is just asking to lose money. This brings us to our final and honestly the most important section,
The rules of survival. A profitable strategy is totally useless if it can't survive a bad week or a bad month. This framework is what separates a professional approach from just reckless gambling.
Let's be crystal clear here. This isn't a friendly suggestion. This is basically a law of algorithmic trading. Any system, I don't care how brilliant it is, will eventually face a market it wasn't designed for. And when that happens, hard risk controls are the only thing that will prevent it from blowing up. It is not optional.
And this is what those controls look like. Think of them as automatic circuit breakers for your money. If the bot loses too much in one day, it automatically stops opening new trades. If it hits a really deep drawdown from its peak performance, it shuts down completely until a human, you, can figure out what's gone wrong. This is your automated defense system.
So your first line of defense is at the trade level. You never ever risk more than 1% of your total capital on any single trade. This one rule makes sure that no single bad idea can do serious damage to your account.
Your second line of defense is daily, the 3% daily loss limit. This rule is simple. No matter what happens, you don't lose more than 3% in one day. It's what keeps a single bad day from turning into a catastrophic one. And finally, your ultimate failsafe, the 15% maximum drawdown. If your account value ever drops 15% from its highest point ever, the whole system just stops. This is the emergency brake. It preserves your capital so that you can fight another day.
So, at the end of the day, it all comes down to this. Your goal isn't really to find some magic algorithm that just prints money. Your real goal is to build a robust system that can handle uncertainty and, above all else, survive. Because in this game, longevity is everything, and that is how you separate the signal from the noise.